For more reaction to this morning's CPI report and what it means for the Fed's policy decision next week, I want to welcome into the program former Cleveland Fed President Loretta Mester. Loretta, thanks so much for joining me. It's always great to see you.
Thanks, Jennifer. Glad to be with you.
Your reaction to this morning's CPI report, and how do you think the Fed is viewing this?
Yeah, well, it came in as most economists expected it to, but from the Fed's point of view, the unfortunate thing is that it does show that we've had sort of a stall out in the progress that was made earlier on inflation. And I think that's got to be a bit of a concern to the Fed in the sense of, I do think they're going to be slowing down at least what they thought they might be doing in September. Remember, we had a summary of economic projections in September that suggested they would do another cut this year and then four more next year, four more 25 basis point cuts next year, or 100 basis points. And I think that's got to be rethought because there's just a lot of underlying momentum still in the economy, and inflation is not showing much progress over the past 4 months. So I think there's going to be a rethink about what that appropriate policy path may have to look like next year, even aside from prospective fiscal policy actions, which are still largely unknown, but we know are coming.
Before I get more into how many rate cuts you think we could see for next year and whether that gets scaled back, do you think then that there's a risk that inflation is stalling here and perhaps settling at a higher level versus tougher comparisons, and that we could see, as we go into the first quarter of next year, perhaps inflation come down, given that inflation spiked so much in the first quarter of this year?
No, you're right. I mean, there are these base effects, and you have to think about those as you're forecasting out inflation. But we're going to get the December SEP, and that'll really give us a very good look of how the Fed participants, FOMC participants, are thinking about what's going to happen to inflation. If I were forecasting, I would have to, well, certainly, the median will go up because I just think that we haven't seen as much progress. So we're going to see, I think, certainly for 2024, they're going to have to raise what they had in the September SEP because the data is basically in and we know what inflation is going to do. They'll have stronger growth for this year. Now, next year, the numbers may not be that much different, but it may be that the policy path to get those numbers will have to be changed. And I think that's more likely. I think they're still going to say, and I think this is true, that inflation is on a downward path. We know it's a bumpy downward path. It's not every month we see a number that shows inflation coming down. But I think it's going to take a bit longer than they probably thought it would in September, and it'll probably take more restrictive policy than they thought in September. Not necessarily that the Fed will be raising interest rates, but the policy path will be firmer than what they thought in September, I suspect.
So then, Loretta, do you think they still cut by 25 basis points next week? And given your sentiments, what do you think the median forecast settles out for next year? Are we looking at 3 rate cuts, 2 rate cuts versus the median of 4 that we saw penciled in September?
Yeah. I mean, 2 or 3 next year seems about right to me, but the medians can move on, depending on what the mix around the participants is. But I think it'll definitely be fewer than 4. The December meeting, they haven't really prepared, and they had some opportunities to tell the markets, hey, we're really contemplating a pause at this point. And frankly, whether they pause in December or go ahead and do that rate cut, which is you could justify based on sort of the progress that has already been made on inflation, and then think seriously about, maybe pausing in January so that they can pause and assess what's, likely to be coming next year in terms of inflation and also the employment part of the mandate. We can't forget that important part of the mandate either. We've had some numbers that suggest that things there certainly aren't as the risk to the downside in the employment part of the mandate have eased since September. So again, the economy seems to be on a good footing, and the upside risks to inflation have risen, the downside risks to employment have fallen. And so that means that the policy path going forward will be probably firmer. I mean, I think that they're more likely to follow through in December and then think about next year. And, they'll be able to talk, the chair will be able to speak in the press conference about how they're thinking about the coming year and whether something's fundamentally changed in their view that inflation's coming down. I don't think it should. I think that the best, the modal forecast is that inflation will be moving down and there'll continue to be progress, but it'll probably take a bit more firm funds rate than they were expecting to have to do. I think they still want to get toward neutral, but I think it'll just take them a little bit longer to do that.
And quickly, before I let you go, we did hear from President-elect Donald Trump this past Sunday on Meet the Press that perhaps he's looking at tariffs more towards a negotiating tool. Of course, we don't know, how that will play out, whether we'll see retaliation from other countries, how long tariffs could be levied, the level of those. But generally speaking, how do you expect tariffs could impact monetary policy decisions and the path for policy next year?
Well, I think the Fed is going to be doing some, and I hope they're doing sort of investigating by their models, sort of what are plausible alternative scenarios for tariffs, and then running them through the model so they'll get a sense of the impacts. Tariffs, it really depends on where the tariff is put on, which goods, whether it's passed through into prices to consumers depends on what the elasticity of demand is for that good. If consumers don't react much when there's price changes, the producers will pass that tariff on. But on goods where consumers are very much willing to, pull back on spending, then the producers will take it. So there's going to be relative price changes. Typically, you think about tariffs as being like a supply shock, which means it's going to increase prices, but then the inflationary impact will be flatter. But of course, I'm loath to say that because we had rolling supply shocks, during the pandemic and after the reopening of the economy, and we did see inflation. So I think the Fed's going to be attuned to that and making sure that it's doing the analysis and talking to businesses. That's one thing that the reserve banks are very good at. They go out and do a lot of reconnaissance with businesses to see how they're planning to react. And then they can feed that into their thinking about the outlook for the economy and therefore appropriate monetary policy.
All right, Loretta, we'll have to leave the conversation there, but thank you so much for your insight. So appreciate it. We'll see you soon.